Evening, everybody. It's my incredible honor to introduce a distinguished leader, Cleveland Federal Reserve President Loretta Mester. She plays an incredibly pivotal role in shaping the economic landscape of our region and our nation. We have the privilege of hosting a remarkable individual whose wisdom, expertise, and commitment to economic stability have made an invaluable asset to our nation and our community. President Mester graduated summa cum laude with a Bachelor of Arts degree in Mathematics and Economics from Barnard College of Columbia University. She earned an MA and PhD in degrees in economics from Princeton University, where she was a National Science Foundation Fellow. President Mester's journey to her role as Cleveland Fed President started when she joined the Federal Reserve in 1985 after earning her PhD from Princeton. President Mester's tenure as a president and CEO of the Federal Reserve Bank of Cleveland, which began in 2014, has been marked by her steadfast commitment to the Federal Reserve's dual mandate of price stability and maximum sustainable employment. In her role, she participates in the formulation of U.S. monetary policy and oversees more than 1,000 employees based in the bank's Cleveland office and branch offices in Cincinnati and Pittsburgh. And these individuals conduct economic research, supervise banking institutions, promote community development, and provide payment services to depository institutions in the U.S. Treasury. Her insightful leadership has contributed significantly to the Federal Reserve's efforts to navigate the complex economic challenges our nation has faced over these last few years. Beyond her professional achievements, President Mester is known for her engagement with and dedication to our local community as well, where she is a director of the Greater Cleveland Partnership, a trustee of the Cleveland Clinic, a trustee of the Musical Arts Association, and she understands the unique economic dynamics of Cleveland and the broader region. As we look to the future, we are fortunate to have leaders like President Mester who are tirelessly working to ensure the resilience and prosperity of our economy. I have no doubt that her address today will provide us with invaluable insights into the economic landscape that lies ahead. Please join me in extending a warm welcome to President Loretta Mester.
Well, Dan, that was quite an introduction. I really appreciate it, and I really appreciate the invitation to be with you all tonight for this 50 Club event. I think this is a very great time to be here to talk about the economy because the FOMC, which of course, as you know, sets monetary policy, met less than 2 weeks ago. So I can't think of a better time to kind of give you an update on the economy and monetary policy. And I need to let you know that my remarks tonight are my own and not necessarily those of the Federal Reserve System or my colleagues on the FOMC. So that's the first time I've ever said that and gotten applause for it, I have to say. But we are unique in Cleveland, so very good. So actually, the Cleveland Fed is only a couple of blocks away from here, and we're actually celebrating the 100th anniversary of our building this year. We're really proud to be part of that architectural history of Cleveland. I know many people come to Cleveland to actually look at the architecture because it is very interesting. Of course, we're even prouder at the Fed to be part of the civic landscape. And I actually feel really privileged that I'm able to represent the 4th Federal Reserve District at our FOMC meetings in Washington, D.C. And of course, as you know, our district comprises all of the state of Ohio and parts of Pennsylvania, Kentucky, and West Virginia. So I wanted to say tonight, start by just thanking you all, because many of you are involved in monetary policy making yourselves. You might not know that, but because of the information that you generously provide to us, your insights on economic conditions, your insights on what's happening in banking, whether it is through our surveys that we run, or as members of our advisory councils, or as directors of the Federal Reserve Bank. That is really invaluable information. That really tells us a lot about the economy. And what's good about it is it tells us not only helps us evaluate where the economy is, but where it's going, because it tends to be forward-looking information. So it actually helps me formulate my own views on monetary policy, which fosters our statutory goals of price stability and maximum employment. So again, thank you for the public service you're doing and helping us set monetary policy. Now, before I turn to the outlook for the economy, I think it's a good idea to recap where we've been. So if you think back, and I know I have trouble even thinking back because I lost my sense of time during the pandemic, but if you think about the pandemic before it hit in early 2020, the U.S. economy had been on really solid ground. It was the 11th year of an economic expansion. The labor market was very strong. The unemployment rate was at historically low levels. Jobs were growing at a solid pace. And participation in the labor market was also quite good. Now, after being too low for some time, inflation was actually nearing the FOMC's longer-run goal of 2%. Of course, the pandemic changed all that. The economy shut down in March 2020, and fiscal and monetary policy makers took aggressive actions to support households and businesses, ensuring that credit continued to flow and limiting lasting damage to the economy. Now, when public health statistics began to improve in May 2020, many parts of the country began to relax some of those stay-at-home restrictions, and the economy began to reopen. But that was not business as usual, right? The mandated shutdowns and the voluntary pullback in demand for high-contact services led consumers to shift spending, and they shifted their spending from services to goods early in the pandemic. As health conditions improved and the economy reopened, demand surged, and it was supported by fiscal transfers and accommodative monetary policy. So spending has been shifting back from goods to services, although if you look at the spending levels in both of those sectors, they're not quite back to their pre-pandemic trends. Now, as many of you know, the pandemic also led many people to leave the workforce, making it much more difficult for firms to find the workers they needed. And remote work became much more common. That led to changes in demand for housing, and sales of new and existing single-family homes surged in 2020 and 2021. And in addition, supply chains were disrupted, making it much more difficult for firms to keep up with demand for their products. Now, the changes in spending patterns, housing demand, workforce participation, and supply chains led to a situation in which both demand in product markets and demand in labor markets became out of balance with their supply. And those imbalances occurred in an environment of accommodative fiscal and monetary policy, which led to a significant increase in inflation starting in the spring of 2021. Then Russia's invasion of Ukraine in February 2022 added to inflationary pressures, spurring higher prices for oil, food, and other commodities. In 2022, so just last year, headline inflation reached levels not seen in 40 years, running 7 to 9%, depending on which measure you look at. Now, in response to that sharp rise in inflation, the Fed began tightening the stance on monetary policy in March of last year. And since then, the FOMC has raised the target range of the federal funds rate, which is our policy rate, by 5.25 percentage points. And we're also reducing the size of our balance sheet by allowing assets to roll off in a systematic way according to the plan we announced in May 2022. And that balance sheet reduction is also firming the stance of monetary policy. So that tightening of monetary policy has led to a broader tightening in financial conditions in the economy. Treasury yields, mortgage rates, and credit spreads have risen. Banks have been tightening their credit standards, making credit less available to businesses and households. But that contraction in credit has not been sharper than what one might expect given the rise in interest rates. So as this tighter monetary policy has transmitted to the broader economy, demand has begun to moderate. And at the same time, supply chain disruptions have improved. And, we talked to a lot of businesses, as I said, our business contacts are reporting that the bottlenecks have eased, and survey data indicate that delivery times have shortened. Now, businesses have also told us that they've learned how to better navigate supply issues. So both demand and supply are adjusting and coming into better balance. So real output growth has slowed from its robust pace in 2021, but the economy appears to have had more underlying momentum than was apparent at the end of last year, and consumers have been particularly resilient. Consumer spending is about 70% of GDP, and it's been increasing at a pretty good pace this year, supported by strong income growth and savings that accumulated during the pandemic. Businesses have moderated their spending on equipment and software as demand has slowed, but our business contacts are more optimistic than they were at the beginning of the year, that they're more optimistic that the economy will avoid a recession. In the housing market, there's a longer-term shortage of available housing. So despite the sharp increase in mortgage rates over the past 2 years, and the 30-year rate is now nearing 8%, housing starts and sales of existing homes have stabilized, and sales of new single-family homes are beginning to pick up again. So if you look at that as a whole, the overall performance suggests there's more underlying momentum in the economy than we thought even just 3 months ago. And in fact, if you look at the FOMC participants' projections of economic growth this year, they were revised up at our recent meeting. Now, instead of projecting that growth will be well below trend this year, the median projection is that growth will be a bit over 2%, which is somewhat above trend. Now, growth is expected to slow below trend next year as tighter credit and financial conditions and waning fiscal support for households weigh on spending. Now, labor market conditions remain strong, but they also are moderating, bringing labor, demand, and supply into better balance. So if you look at Ohio, the unemployment rate is 3.4%, so that's near its historical low. But our business contacts say that they're seeing some easing in the labor market with increases in job applications and in the number of candidates coming in for interviews. Only a small number of firms told us that they plan to lay off workers this year, but many firms said they're slowing their hiring, and fewer businesses are hoarding workers since has become easier to hire. And we're seeing the same thing in the national job market. The national unemployment rate is low. It's at 3.8%. There was a rise in August, but that was mainly because of an increase in labor force participation. Job growth has slowed over the course of the year, with payroll gains averaging 150,000 per month over the past 3 months. At the beginning of the year, over the first 3 months of the beginning of the year, it was 300,000 per month. So that's a slowing. The number of job openings has also been declining, but if you look at the ratio of job openings to unemployed workers, it's still 1.5, and that's still above the 1.2 level we saw in the strong labor market conditions in 2019. So labor markets are adjusting, supply is becoming in better balance with demand, but I'd still characterize it as a solid labor market. Now, wage pressures are easing by some measures. Firms in our district tell us that they're not having to adjust compensation as frequently as in the last few years, except for those workers with specialized skills and in sectors with shortages like nursing. Expected wage increases among our contacts have moved down, but they're still at 4%, and that is higher than the wage gains we saw before the pandemic. In the nation, wage growth is still well above the level consistent with 2% inflation, given current estimates of trend productivity growth. So while increased labor force participation by prime-age workers is helping to ease the imbalance between labor demand and supply, it seems likely that labor demand conditions are going to need to ease further to bring wage growth down to levels consistent with 2% inflation. Now, again, in the September FOMC projections, the median participant expects that the unemployment rate to rise over next year, but only a little, to 4.1%, which is consistent with a moderating but still solid labor market. So as I mentioned, the Fed's inflation goal is 2%, and we measure that by the annual change in the price index for personal consumption expenditures, or PCE inflation. Inflation has been running well above the Fed's goal for more than 2 years. The good news is that the overall economy remains relatively strong, and at the same time, we're making discernible progress on the journey back to price stability. Inflation levels, both the headline numbers, which include food and energy prices, and measures of underlying inflation, including the core, median, and trim mean measures, have moved down from their peak. So if you look measured year over year, total PCE inflation peaked at 7% in June of last year. As of this August, it's fallen to about 3.5%, so it's been cut in half. And that's despite the recent rise in oil prices. Other measures that strip out the components with the most extreme price movements each month, and we do that because that gives you a better idea of where the inflation is going, the trend. Those are also improving, those measures. The Cleveland Fed Center for Inflation Research produces and tracks a number of inflation indicators. And the Cleveland Fed's median PCE inflation measure peaked at just over 6% in March, and it's now down to 4.5%. And core PCE inflation, which omits food and energy prices, peaked at over 5.5% last year, and it moved down to under 4% in August. And if you want to see even better signs of progress, you can look at price changes over shorter time horizons, such as 3-month or 6-month annualized inflation rates, or look at what's happening with the prices of core goods excluding food and energy. Now, despite that good progress, inflation remains too high. And we're going to need to see continued progress on inflation in goods prices and also in service prices. Consumers spend a larger share of their income on services, so services have a higher weight in the inflation indices. If you look at sort of what's in services, housing services, inflation in those services measured by rents and the imputed rents for owner-occupied housing, it remains elevated, but it's begun to slow because rent inflation in new leases is slowing. The problem area is inflation in core services excluding housing. That's shown very little improvement over time. In addition, the risks to the inflation forecast remain tilted to the upside. So we've really been helped on our inflation journey by the fact that despite high inflation rates, medium and longer term inflation expectations remain relatively well anchored in a range consistent with the Fed's goal of 2% inflation. But oil prices are now increasing, and there is a potential that they'll pass through to other core prices and stall progress. And in addition, because gasoline prices are particularly salient for households that have to fill up their cars or trucks once or twice a week, rising gasoline prices could begin to make consumers think inflation will be rising again. If so, higher inflation could become embedded in people's views of the economy and then affect their behavior in ways that are inconsistent with price stability. In fact, when we asked our regional business contacts their expectations for inflation, the mean response was nearly 4% for the year ahead and 3.2% for the next 5 years, which of course is considerably higher than our target. Now, while we have not yet completed the journey back to price stability, there should be no doubt that the FOMC will get the job done. To achieve our long-run goal of 2% inflation in a sustainable and timely way, we're going to need to see continued sustained disinflation, and that will likely require further moderation of demand in both product and labor markets. So that brings me to monetary policy. So at its recent meeting, the FOMC decided to maintain the target range of the Fed funds rate at 5.25% to 5.5%, and to continue to reduce the Fed's security holdings. Now, in determining the extent of additional policy firming that may be appropriate, the FOMC is going to be assessing incoming economic and financial developments, as well as assessing the cumulative effects of the tightening done so far since we know that monetary policy affects the economy with a lag. The economic projections released by the FOMC in September indicate that the median participant thinks another rate increase will be appropriate this year, and that monetary policy will have to be held sufficiently restrictive for a while in order to get inflation back down to 2%. So that's consistent with my own reading of economic conditions, the outlook, and the risks to the outlook. At this point, I suspect we may well need to raise the Fed funds rate once more this year and then hold it there for some time as we accumulate more information on economic developments and assess the effects of the tightening in financial conditions that has already occurred. But whether the Fed funds rate needs to go higher than its current level and for how long policy needs to remain restricted are really going to depend on how the economy evolves relative to the outlook. There's considerable uncertainty around the outlook. For example, the slowdown in the Chinese economy, the possibility of an extended UAW strike, and the potential for a government shutdown later this year all pose some risks around the outlook. So policy decisions are going to need to be guided by actual progress on our dual mandate goals, in particular, whether the good rate of progress we've seen on inflation over the past 3 months is sustained, and whether labor market conditions remain healthy as they moderate. This is going to require us to carefully monitor economic, banking, and financial market developments and to collect reports from our regional contacts so that we can set monetary policy in a way that balances the costs over time of over-tightening versus under-tightening monetary policy. So tightening too much would slow the economy more than necessary and entail higher costs than needed to get inflation back to our goal. Tightening too little would allow high inflation to persist with short-run and long-run consequences and would necessitate a much longer and more costly journey back to price stability. So let me conclude by explaining why I think it's important that we return the economy to price stability in a timely way. So I want to guard against becoming complacent with moderating inflation if the pace of the moderation implies it's going to take longer and longer to achieve the Fed's 2% goal. And many forecasters have been underestimating the persistence of inflation since the beginning of this high inflation episode. FOMC participants have been pushing out the date of when inflation is expected to return to our goal. For example, if you go back and look at the June 2021 median FOMC projection, it had core inflation moving down to 2.1% in 2022. A year later, the median projection had core inflation not reaching our goal until after 2024. And now, according to the median projection in the September SEP, our 2% goal is not expected to be reached until 2026. Now, when inflation persists at levels above our goal of price stability, the price level is moving up faster than we'd like, and households and businesses have to pay those higher than desired prices. Since the first quarter of 2021, when inflation began to rise, inflation has been running at an annualized pace of nearly 5.5%, while worker compensation has risen less at an annualized rate of just over 4.5%. So that means that despite sizable increases in nominal wages, compensation adjusted for inflation hasn't been keeping up with the high rate of inflation over this episode. And that's likely part of the reason that Cleveland Fed surveys, which we survey a lot of people, they find that people have a very strong dislike of high inflation. High inflation also imposes longer run costs on the economy. It makes it harder to plan for the future. It affects people's decisions about getting an education or training for a new job. It affects businesses' decisions about whether to invest in new plants and equipment. And those types of investments in human and physical capital help to determine our economy's pace of innovation and productivity growth, and therefore its potential growth rate and our longer run standard of living. So it's costly to our economy in both the short and long run to allow inflation to remain so high for so long. Finally, getting inflation back to 2% in a timely way puts the economy in a better position to weather the next shock, whenever it occurs. An economy that's at maximum employment and price stability is a stronger economy and one that's more resilient to shocks. So in summary, the economy is on a good path. Demand is moderating and supply conditions are improving. Labor market conditions remain strong, but the imbalance between labor demand and supply is narrowing, and firms are finding it easier to find the workers they need. Progress is being made on inflation, but the level of inflation remains too high. We're likely near or possibly at the peak of the Fed funds rate in this tightening cycle. Now our task turns to ensuring that we keep monetary policy restrictive for long enough to be confident that inflation returns to our 2% goal in a timely way. We're not there yet, but we will get there because price stability is crucial for the long-run health of the economy, of the labor market, and the stability of the financial system. Thanks for your attention. I'm looking forward to hearing what's on your mind in the discussion to follow.
There's wheels here. Let's go like this. Yeah, I'll just come back in the corner. All right. Full service. Thank you. Thank you for those amazing remarks and for filling us in on what's going on. What we're going to do here is Q&A. I've got a few to get us going, but please, again, don't be shy. Come on up and ask questions as you see them. But excuse me, just to tee things up, I think about, we look closely at the yield curve on a regular basis, and I think you covered a lot of this. But one of the things that I've heard lately, if you look back in 2007. The 10-year was in the high fours like it is today. And then since then, it's been on this new normal. And now you hear kind of this idea that we're in the new old normal. This idea that we're back to kind of this sustained rate. Even if you look at, cutting rates at some point when you feel like the target's in sight. Do you think we're kind of in this general new band from a rate perspective going forward? Should be hopefully on. There you go.
Okay. Can you hear me? So certainly, if you look at what happened, after the great financial crisis and all, we did see that sort of that equilibrium, normal interest rate was much lower. For the foreseeable future, given that we need to get inflation back down to 2%, right, we're going to keep interest rates, restrictive in order to get inflation down. Your question, though, points out that there's also a discussion about what that neutral Fed funds rate is, and there's some people who think that it might have risen during this episode, and so that you're going to need to keep interest rates higher. I don't think we know that yet. I don't think we're going to have an answer of that, over the next year or 2 years, but there's certainly a discussion about that. Partly being driven by government spending and deficits as a pressure, putting upward pressure on that, which economists like to call R-star, But I think for the purposes of today's discussion, we've signaled and said and believe if you look at the projections, that the interest rate is going to be staying up either at the current level or maybe slightly above the current level for quite some time, because we need to really make sure that that disinflation we've been happy to see continues. And so that's part, if you look at the horizon in the SEP, interest rates stay up for most of next year until they start to come down once we're convinced that inflation is really on that downward path.
So you look at different factors that can help drive down inflation. I know next month we have Paul talking about artificial intelligence. Any views or weighting that the Fed does in looking at some of those productivity pickups or other impacts that AI might have on our economy?
Right. I mean, AI is a very interesting, I was talking before the talk. I mean, it will, I believe, it is going to change a lot in the economy because it's different than what we've had before, right? We've had innovation in the economy forever, right? This is a little different than computers, right? Which, of course, now everyone has a computer, right? I have an iPad. I did my talk on the iPad, right? When you code in a computer, it's step by step by step. Generative AI has the potential of actually being able to do things that we do intuitively, but we couldn't write down exactly what step we did to make the decision. And so that can change the nature of work and can change sort of the skill sets you need. So I think it's an exciting tool, but it also is a tool that has potential implications for what workforce development, you know, what jobs, what sectors. And so we do think about those things, obviously not in the short run for monetary policy purposes, but in terms of if you think about what is the work going to look like going forward, what jobs are going to be in demand, what productivity enhancements will we be able to garner with it. Those are exciting things, but you need to think ahead of them about them ahead because we want to make sure that, you know, the jobs that aren't going to be around, right, those people can be trained for the jobs that are going to be around. And this is a workforce development issue that's not just because of generative AI, it's just in general, right? We want to make sure that people can stay attached to the labor force, which means higher and higher skill sets. And what's great about Cleveland is there's a recognition of this and that we're working to try to make sure that people get the training they need through the great universities and colleges here.
Again, please consider some questions. If we can just raise your hand and we'll get to, I see somebody in the back. I think if you wouldn't mind, Terry Coyne, come on up, if you don't mind. There's a microphone right up here. While you're making your way, one other thing I'd just like to ask you real quick is you mentioned Cleveland, Ohio. When you look at our region, your region, and you look at other, we'll take Terry's question first, and I'll come back. So go ahead, Terry.
So student debt hasn't been paid for 3.5 years, and it started, I think, today. What will that do to the economy?
Well, there's definitely going to be people who are going to now have to shift some of their spending to paying off that debt. So we'll see a little bit of that affecting consumer spending going forward, as we have seen as savings have come down, right? The consumers are moderating their demand. And so that's built into our forecast. There's different estimates of how big that'll be, and it'll depend on sort of how it's implemented, but there's a lot of also safeguards from the federal government on making sure that people aren't sort of left, you know, that you can stretch out the payment. So it'll be one of the factors that is a moderation of consumer spending, but it's not going to be probably an abrupt change in what we've been seeing in the economy so far.
Thanks for your comments. I'd like your perspective on an externality, which is if the world begins to reject the dollar as the reserve exchange, reserve currency for exchange to oil markets and other, as you've seen in BRIC countries, China, perhaps Middle Eastern countries, if that catches on as a trend, what do you see the risk of that catching on, number one? Number two, what's the impact for our economy?
So I don't see that being a risk. Our dollar is, you can see it in financial markets when there's the financial, you know, if there's a shock to the financial system or the global financial system, everyone runs to the dollar. The dollar is a very strong currency, and it's the currency that people demand. So I do not see that as a risk. And I think that, you know, we've seen evidence that, right, when there's issues in other countries, people want the U.S. dollar.
Just to give you a sense of the ubiquity of that notion, my mom asked me that question last night, and I told her just what you said.
I got it right.
Hi, so my banker friends asked me to ask this question. Why would the Fed be asking the banks to increase the level of capital when that's not going to solve the problem that we recently faced with Silicon Valley Bank and others? I mean, really, the capital levels are pretty strong, and that will really have a detrimental impact on the economy.
Yeah, so the Vice Chair of Supervision, Michael Barr, right, has put out proposals and requests for comments on what I would consider sort of a portfolio thing. So part of it is capital, right? And as you know, higher capital levels means there's more reserves for a bank that, has some losses that, they can use their capital to shore up those losses. But at the same time, there's also work going on to make sure that the supervision of the banks is very solid. That's one of the things we saw in SVB as well. So there's work going on generally to try to make sure that the banking system has the capital levels needed, right, to make sure it's a healthy one and financially stable one. And that's out for comment, and we're very interested in hearing what bankers have to say about these proposals. And so if you are a banker in this room, I would encourage you to put in your comments on those proposals. But the intention is to try to make the banking system more stable, but at the same time recognizing that banks are incredibly important for the health of the economy, right? The lending that banks did, think about back to the beginning of the pandemic. The banks, right, did a lot of lending that really got us through. So I think everyone at the Fed, and I'll speak only for me, we recognize the important role that banks have, but we also want to make sure that it's a stable and resilient system, and that's kind of the decisions being made around supervision, making sure that we're supervising at the highest level, making sure that capital levels are appropriate for the risks being taken on in the industry. But again, if you're a banker, I would encourage you to put in comments on the proposals that are out.
Yep. Mark Philippel.
Hindsight's always 20/20, and certainly there have been a lot of external forces at work over the last few years that were impossible to predict. But if you could look, knowing what you know now, if you could go back, time travel 5 years back, what could the Fed have been doing differently, and what could the federal government have been doing differently so that we wouldn't have been through this roller coaster of interest rates and back and forth?
Okay, well, I think part of what happened, it's not 5 years back. I mean, the pandemic was a huge shock to the economy, one that we haven't seen before. And so, I'm not sure that going back 5 years and doing something differently would have done much, right, about the pandemic, right? It was a huge global shock, and countries had to take actions. And if you remember back, this is the thing that I think people forget. It's like the predictions about what was going to happen to the economy from that were really dire, right? Because it was new, we didn't know. And so actions were taken. I think since then, right, I think one of the things, we at the Fed, we did end up having to raise interest rates at a pretty quick pace, right, in the beginning because inflation was going. And there was some, I'd say miss in terms of what was causing that high inflation, right? A lot of it was supply driven. So when you have a situation where both demand and supply are moving, yeah, you may have gotten a little behind, but we caught up, and now we're in a good spot. So I think there's a lot of work going on, rightfully so, and sort of looking at, what could we have seen that sooner? Could we have moved a little sooner? Would that have mattered much? And there's different views about that. But, you're in a very uncertain environment, and you said it best, right? You can't really foresee the future. We do the best we can with the tools we have, and we're developing new models and new forecasts as we go. I'll put a plug in for our Cleveland Fed's Inflation Research Center, because it's been doing really good work in trying to not only develop models, but actually gather information by surveys and really going to the people who actually set prices and asking them, well, okay, how are you doing this? And that's going to inform our models going forward. So I guess this was a learning episode, and hopefully we're better prepared for the next time.
Yeah, hopefully there's not another pandemic anytime soon, right? No, great questions. We have time for maybe one or two more, or maybe, go ahead. President Bloomberg.
Hi, I'm Laura Bloomberg. I'm at Cleveland State University. But I spent a large part of my career in Minneapolis and worked very closely with the Opportunity and Inclusive Growth Institute at the Minneapolis Fed. And it had me thinking a lot as a policy scholar about how is it that our economic policy is designed so it works for all of us, which is, I'm sure you're familiar with that work at the Fed there. How are you approaching that here in Cleveland when we think about opportunity and inclusive growth?
Ooh, that's a wonderful question. The Cleveland Fed is doing a number of things, working with many people in this room. We have I think, a very robust community development department, and we have a program on economic inclusion. And they work together to try to address some of the issues that you're talking about in terms of the Minneapolis Fed is doing. In fact, we partner on some things. So, one of the things that we've been working on are basically workforce development in terms of skill sets and making sure that people understand that there are good jobs out there that don't necessarily require a college education, but do take some training, and giving people skills, the tools they need to see, like if they took this new job, right, what could their career path look like, and how much would they be able to make a higher salary? So there's a lot of work going on that. There's work on trying to address the impediments to work. So some of it's education, but some of it are many more basic things like childcare and transportation. So we're doing a lot of work on that because I think that's not as clear to some people and some businesses that those are real issues. And some of the businesses that we talk to are trying to address some of those issues. So there's a lot of work going on. And then our program on economic inclusion takes the view that, look, maximum employment, right, is critical for the economy. How do you achieve maximum employment? Well, you need to make sure the economy is inclusive. You want the workforce. You want everyone to be able to get into the workforce and stay attached to the workforce. So again, it's very much tied to the Fed's goals because a stronger economy is actually what we're trying to promote. So I would welcome anyone to kind of take a look at some of our work in this area, and I'd love to partner with you in the room, anybody who's interested in doing more.
Okay, one more question. Go ahead, Mac.
So my question is 2% inflation obtainable with the national debt going as quickly upwards as it currently is? And if so, can you do that without causing a recession? And if so, what kind of interest rates do you need to do to accomplish that?
Yeah. Yes, and the path in the SEP is a pretty good guess. No, yes, 2% inflation is definitely achievable, and we will do that. We're going to be able to achieve it even with the fiscal situation. However, I agree with you that it would be good for the economy to have a plan, a longer run plan of how to get right on a sustainable fiscal path. And the final thing is, we put out sort of and the Chair Powell after press conferences really tries to be as transparent as we can about our thinking about interest rates. Of course, we're going to be guided by our goals, right? So we do believe that we're probably at or near the peak, and the real conversation now in the room is, okay, how long do we need to keep policy restrictive in order to be confident that inflation is on that way down back to 2%, our goal. And that's going to be, I think, where the phase we're in now is assessing that restrictive and how long interest rates will need to stay at the level they are. But our best projection at this point is that it's going to take some time with interest rates at near their current level in order to be convinced that inflation is going back down to 2%.
Are you able to cover the growing national debt as a topic, as a follow-up to Mac's question, in terms of the impact that has on that calculus?
Well, I think the issue that we were talking about for your first question is, right, that has some effect on what that neutral, right, interest rate will be. So to the extent that, we don't get on a sustainable fiscal path, that in the longer run, that may put upward pressure on interest rates. Of course, other things are involved there too in terms of demographics, et cetera, that might put lower pressure on it. So again, it's an open question. But in terms of the next year, the Fed believes that we're going to need to keep interest rates, pretty restrictive in order to get inflation back down to 2%.
Well, I just want to thank you so much for doing a great job tonight. Thank you, everybody. We're adjourned. We'll see you November 6th, right back here.